Hello, hello. Can everybody hear me? At the back also? Okay, that was, I guess the slides are looking compressed here. Okay. All right, thank you all for staying for this session. I'll try to do justice to, my introduction by hoping that you all learn something from this seminar. So today I'm going to talk about support resistance trading strategies. Basically, how many of you are actually familiar with support resistance out here? Quite a few of you. But I do see some of the hands that are not up, so I'm assuming that I just need to do a brief introduction before we start off with the strategies part. So I'll start with that, and I'll show how a technical analyst draws a support and resistance line manually. Then I'll show an automatic way of drawing support resistance. Then we'll compare that with different strategies like pivot levels, Fibonacci retracements, new highs, lows. And finally, we'll also show you how to see how to use risk-reward ratio in our trading. And we'll also talk about supply-demand zones, or also called support resistance zones. Yeah. Oh, it is not, okay. Okay. Yeah, can you hear me now? Can you hear me? Can you hear me? Okay, great. So this is a typical, a stock chart. On this, if you see, the stock is going up and down, up and down. And as the stock comes down, you'll see that at a certain level, it actually bounces off. This level at which it bounces off is typically called a support. This is for those people who don't know about support and resistance. And then when the stock is going up, at a certain level, it actually reverses, and that level is actually called a resistance. So typically how you use support resistance is in two different ways. So you have to first ask what type of trend you are in. In the previous sessions, I think some people talked about uptrends, downtrends, and all that. If you're a sideways kind of a trader, what you would do is typically you would buy at the support and sell at the resistance. But to establish a sideways trend, you need to have at least 2 peaks and 2 lows, because you need to know कि वो sideways trend है, right? So once you know that it's a sideways trend, then you can use a simple strategy that you buy at the support and sell at the resistance, right? But typically, most of the times, about 30% of the times, the market is trending, and the big gains actually happen in trending markets. So if you want to have a trending approach, the way to actually use support and resistance is when the resistance is breaking out, that is actually indicating a start of a new uptrend. Because when you have a sideways trend, the stock can either break out of the resistance on the top, or it can break down of the support at the bottom. And if it breaks out of the resistance, that is your indication that it's a new uptrend. It's obvious, right? The other way to actually use the support resistance is for selling. So if you have a start of a new downtrend, that is in the sideways trend, if the support is broken, you probably have a start of a new downtrend, and that would be a sort of a sell signal to actually sell the particular stock. Now, in terms of the importance scale, usually most technical analysts will agree that support resistance and trend lines are on the higher end of the scale compared to, say, technical indicators and Japanese candlesticks. Of course, it's a general sort of rating. Classical patterns come even higher than that. Classical patterns are like head and shoulder patterns, double bottom, double top, triple bottom, that kind of things. But usually they are composed of support, resistance, and trend lines. Now, how does one go about drawing a support resistance line manually? So let's try to imagine if we want to do that. As you saw in that earlier slide, resistance is basically going through the peaks in the chart, right? So because it's going through the peaks in the chart, what you have to do is you have to draw a line that goes through as many highs as possible. That's what a technical analyst would do. And for support, you would need to draw a line going through as many lows as possible. Okay? So let's take a chart here. This is a Canara Bank chart, 1 hour chart. You can see here where my red dot is, that there is quite a bit of resistance. This stock is not able to go past this level over here, right? So, but this is an imperfect market. You cannot have all the highs aligning at the same level. So because of that, what we try to do is something as good as possible. So we try to draw a line that is going through as many highs as possible, But the important thing is that you should not have a close above this resistance line. That is important. So for example, you can see that this is a red candle, and that because it's a red candle, the closing price is below that. So it is perfectly valid resistance line. This green candle is what is signifying a breakout of the resistance. Okay? So that's a simple way to draw a resistance line. Now, there's a concept in support and resistance that prior resistance when broken turns into support, and prior support when broken turns into resistance. And because of this concept, when we have done our support resistance analysis on any chart, what that means is that it allows us to predict future support and resistance levels. Once you have, because you know that if you have support and resistance, prior support, that's going to turn into resistance once broken, and vice versa. So that actually gives you a lot of predictive power for the future. And you have analysts coming on CNBC and all that. Most of the times the targets and all these things are predicted using support resistance levels. So how does one go about drawing a support and resistance then? Because if you know on a price chart that a support, a line is sometimes going to be a support and sometimes going to be a resistance, then what you want to do is you want to draw a line that is going through peaks and lows at the same time, because at some point of time it's going to be a support, and at some point of time it's going to be a resistance. So you have to draw it through as many highs and lows as possible. Now, as you can see, the whole process is quite cumbersome. And if you look at the current chart of Nifty, for example, here there's, if you look over here, there's this line where it is acting as a resistance line somewhere here in the beginning, and then it becomes a support over here, and then acts as a support for quite some time before breaking down here. Once it breaks down, you can see that same support level is turning into a resistance, right? And then recently you can see that when that resistance was broken, that after that resistance was broken, the Nifty came back down and then got a support here and bounced back up. So that's the beauty of support resistance analysis, that once you have done your, drawn the support and resistance levels, they are actually reversing and the roles are reversing, okay? Here's another one, which again is sort of at the top level. Now this whole process is quite cumbersome. So what most people end up doing is they don't use support resistance manually, because you have to draw this whole thing. So what we've done in our software Investor is we have actually used several factors to rate our support and resistance, lines. There are many things that are important to know the strength of a support resistance. So first thing is that how many highs or lows does it touch? The more that touches, the stronger it's going to be, okay? Can anybody tell me why that is the case? Why the number of touches are important? Exactly. So the more that touches, the stronger it is going to be, right? Because the probability of that holding is higher if the number of touches are higher, right? That's the basic concept. The next factor is volume. Volume occurs because of big institutional investors, not because of retail investors like us. The more the volume that is accompanying the break of the resistance or support line, the more significant that becomes. So that is also another important factor. The third factor are the recency of the touches. People have a shorter memory. So the recent touches on the support resistance lines are going to be more important. And finally, the length of the line. So the longer the support resistance line, the stronger it is going to be. Okay, so these are the factors. Now, what actually we have done in Investor is we've used AI to actually plot all the levels automatically. So you see the blue, the dark blue and the light blue lines, they are basically plotted automatically by the software. As soon as you visit a chart, they'll be plotted. Now, let me ask a question to all of you. If you're looking, right now you're looking at a daily chart, daily time frame of Nifty. Suppose I go to an hourly time frame. Will these levels remain the same? They will change, right? They should change based on the open, high, low closing prices of an hourly chart, right? And that's precisely what happens. The moment you change the time frame, these lines will adjust dynamically. Okay, and what you have to do, what you can do is, if you feel that some line, level you want to propagate to a different time frame, you can make it permanent and propagate to a different time frame. That's how it is. So as you can see here, what I had manually drawn, and what is drawn by this is matching quite well. The second thing, important thing is, you'll see the different colors, so dark blue and light blue. Now the dark blue line is actually the very strong resistance lines. resistance and support lines based on the factors that I have mentioned earlier. So number of touches, the recency, and the length. So these three factors are used to actually rate the lines, and that's how we get the coloring of the lines. And it's basically the top 20 percentile are very strong resistance. It's just a name we have, and the next 20 percentile is strong support resistance, and so on. So you can configure the auto support resistance using the options dialog box, where you can specify how many bars you want to use for calculating the support resistance, because that's what the algorithm is going to use. Now, I've actually talked about manually drawn support resistance, which is what most technical analysts would do. I've talked about auto support resistance. Now let's compare that with some other strategies like pivot levels, Fibonacci retracements, and new highs, new lows. So pivot points are usually used by day traders, and pivot points are calculated based on the closing prices of the previous day. So for example, Mondays, if you want to do day trading on Monday, you would use today's OHLC data, that is Friday's OHLC data, to actually trade. And there are like 3 support and 3 resistance levels and the pivot point, which is actually calculated, which is then used for trading. So if you were to, I see some people taking photographs. So if you want to drop by the stall, I'll be emailing you the slides. So you can just register your email and mention that you want the slides. Don't worry about taking the photographs. So the pivot levels are basically all these 3 support and 3 resistance levels. Of course, there are pivot levels calculated based on various formulas also, Camarilla and Woody and all that. But on a basic level, if you see an intraday chart like that, you have a pivot level over here, R1, R2. These are all calculated based on the formula. Okay. Now, one thing that you have to understand is that in this chart also, for example, you will see that there is a resistance over here which is not really captured by the pivot lines. And that is what is important. So pivot lines are not going to capture all the resistance levels. These are, you can see that where these dark blue lines are there, there's quite a bit of resistance. The stock was not able to cross that. And that is actually not captured by the pivot levels. Then we have a technique which is called Fibonacci retracements. How many of you use Fibonacci in your trading and all? Sometimes. And that's an important point. Sometimes you have to test it well. So Fibonacci retracements, basically you have to draw a trend line. For the benefit of those people who don't, you basically draw a trend line from your high to a low, and then your entire area of the trend line is divided into the Fibonacci ratios of 23.6, 38.2, 50, and 61.8 and 100%. And then what you do is you simply use them as support resistance levels. Okay, that's the simplest way of using Fibonacci retracements. But you need to use them only when you see them successfully working on the past. So you need to test them well. Okay, so if we look at a current Nifty chart, so this is the current Nifty chart, and I've drawn a Fibonacci sort of line from the peak, all-time peak, to the low. And these are the retracements. So you can see that, for example, the 50% was indeed some sort of a resistance here, right? So they work. Again, the 61.8% was also some sort of a support, and then a support over here, and now maybe there's a resistance over here and all that. But again, these are not going to capture all the supply-demand lines. So, for example, if I were to actually find out the some other levels, then you can see that 8399.55, this is one of the levels that was calculated here. The 8281.25, that actually is a pretty strong level. You can see that was a resistance over here on the left, and a support here, and a resistance somewhere here. So this is not captured by the Fibonacci retracements, right? So because when you go through the highs and lows and then you draw the lines, you are actually capturing the supply-demand lines, right? That's where the supply-demand is actually happening, and you are actually capturing that. So that is why this turns out to be a more accurate way of capturing the support and resistance. So for the benefit of those of you who use pivot levels and Fibonacci retracements, you have to understand that they are mathematically calculated. And because they are mathematically calculated, they are not based on actual supply-demand. In fact, if you really think about it, the rationale that they work is because other traders use them. So they are going to work. Frankly, I mean, I have not found a real scientific reason. Okay, people say that it's in nature, Fibonacci is in nature and all that, but I don't, being an engineer by profession, I have not understood, why they work. The only thing is because everybody else uses it, right? So you are going to see them work better on heavily traded scripts. This is what you have to understand. If you try to use it on thinly traded, you'll probably not find much success with it. And the second thing, the success rate will also not be consistent. It will vary from script to script. So you need to make sure that you test them well before you use them. So that is the important point for both the Fibonacci and the pivot points. The other thing that people use as as a way to trade support and resistance is that if a stock is making a new high, for example, it is acting as a resistance. And if a stock is making a new low, it becomes a support. So you can use a new high and new low also as a support and resistance, but what you use for the resistance and support depends on what type of trading you're doing, whether it's long-term investing, in which case new 52-week high lows is one way to actually use the resistance support. Or if you're a short-term trader, you can use new 8-week high lows or 15-day or 5-day high lows. Okay. And then, as an intraday trader, you probably want to just trade. You want to use above previous days high or below previous days low. Now, here's again one caveat there. So, if supposing you have a stock in this 3-minute chart, you can see that this stock is breaking out, making a new high. The new high is actually broken somewhere here because there was a high over here and it was broken somewhere here. But actual resistance line, which is based on the supply demand, you can see that it was a little lower than that. So that is where you can. Okay. I think this screen is quite bright, so let me see if I can. No. So anyway, so what I'm trying to say is that the top line is basically the new high, right? You can see in the end, that's where the new high is there, right? Now, the lower line is where it is basically touching quite a few highs here. There's one high here it is touching. It's also touching quite a few highs over here. So that's where the real resistance is, because that's where it was not able to close above that, right? So that becomes a stronger sort of a resistance. And based on the actual supply demand, right? So what we are trying to say here is that new high is also a great technique, of course. I mean, it's used by a lot of traders, but at times it will still miss out the actual resistance lines, which are based on supply demand. That's what I'm trying to say here. So any questions so far? I don't want it to be like a one-way session. If you have any questions, anybody? So that's a good point. See, basically the time frame that you use actually depends on what type of trader you are. So if you're a intraday trader, you want to probably use a lower time frame. Generally, 1 minute is too fast for most people. So like at least something like 3 minutes, and always use 2 time frames. You use like say 3 minute and 15 minute, and generally there's a rule that the time frame should be separated by a factor of 4 to 6. So if you're using say 3-minute time frame on the lower time frame, then you use 15 minute on the higher time frame. You look at a picture on the higher time frame as 15 minutes, and then go down and make your final trade on the lower time frame. Okay. Sorry.
I'm asking you as an investor, basically.
So as an investor, what I said was as a day trader. As an investor, what you want to use is higher time frames, let's say weekly and daily time frames.
You are coming to a point where you want to sell off.
Right.
And you want to maximize the potential of gaining maximum.
Right.
So therefore, let's say 1 minute too early, maybe you have time.
No. See, basically, if you're a long-term investor, you want to use higher time frames. You cannot really use lower time frame like 3 minute, 15 minute and all, right? The time frames that you use really depend on the type of trading you do. If you're a long-term investor, you need to use daily, weekly, sometimes even monthly time frames. If your horizon is very long, you can even use monthly time frames, right? And in fact, if you come down to the stall afterwards, I can point you to a blog post that I've done on this, and that can help you out on this. Okay. Any other questions? Yeah. No, see, a new high is basically a breakout of a new high is like a breakout of resistance. Okay, so a breakout of a new high is also a buying signal, typically, right? So a lot of famous investors like William O'Neill and all, they have a technique which is based on this, which is like a 52-week highs and all, like when the 52-week high is broken. That's basically that only. It's a break of a resistance. It's a buy signal. If you're a trending trader, the important point is you have to identify what you are trying to do. Are you a sideways trader or are you a trending trader? If you're a trending trader, then a breakout of a new high is actually a buy at the entry point actually. Exactly, yeah. So the good stocks are always going to make new highs over some time, right? Okay. All right. So we'll come to the another very important concept that is used by traders, and that's the risk-reward ratio. How many of you are familiar with risk-reward ratio here? Quite a few. Good, good. But I think almost half of you are not. So I'll just quickly define it. The risk-reward ratio, although it's written as risk/reward, it can be written, I mean, it can be said anyway, but typically it's maximum profit divided by the stop loss that you have, right? So for any trade that you're taking, knowing the risk-reward ratio is important, because if you are right on that trade, you want to maximize your profit. It is not going to tell you whether your trade is going to go right or wrong. It is going to tell you that, okay, if you are right, then what is the profit potential? And having a high reward to risk, high reward versus risk, you can maximize your profit potential if you're right. That's the idea. Okay. So how does one calculate the risk? Risk is the maximum loss you can have. Reward is the maximum profit you can have. And generally, even more than 2 is considered good. But if you have a 3:1 risk-reward ratio, that is considered pretty good. The high risk reward minimizes your risk and maximizes your profit, and it's widely used by professional traders. So how can you possibly do a risk reward calculation? Because now the stop loss element is actually going to depend on what type of trader you are. And why is that? It's because of this table here that I mentioned, that if you're an intraday trader, really speaking, 2 to 3% gain is pretty good for an intraday trader. So depending on what kind of a gain you're expecting, your stop loss also you have to put that way, right? You cannot put a 5% stop loss here. So the stop loss for an intraday trader typically is 0.5 to 0.75%. And because the ideal gain is this, that gives you a higher than 3 risk reward ratio, okay? For short term, a 15 to 25% is an ideal gain. So in such a case, your typical stop loss will be 5%. And as you go longer term, your expectation of gain is going to increase because you're going to hold for a longer time. In that case, your ideal gain can be, say, 50%, and your stop loss, typical stop loss, you can increase to 10%, 15%, something like that. Okay? That all these things are, the stop loss is done based on the type of trader you are. That is the important point. So whatever risk-reward ratio calculation you are doing has to incorporate what type of trading you are doing. Everybody with me? So how do we then calculate the risk-reward ratio? One thing is that we need to calculate the reward, which is the maximum profit you can have. This whole thing is actually can be configured. But before doing the stop loss thing, let me tell you how the reward is calculated. Now, if you're buying a stock, on a breakout or something, what is your target going to be? Anybody? Any guesses? Exactly, so something similar. What you said is if you're using pivot points, your target is the next resistance. What you're trying to say is that your target is the next resistance, because that is where you expect the stock to at least pause before doing its next move. Am I right? Am I making sense? So when you actually want to calculate your reward is going to be basically how much is the percentage gain that you have up to the next resistance. Everybody with me? So that's why if you are a long trader, that is if you are buying, then your profit is going to be the nearest resistance minus the close, assuming you're buying at the close. Suppose you're buying at the closing price, then your profit is going to be the nearest resistance minus the closing price. If you're shorting, then it is the opposite, right? Because if you're shorting, where do you expect the stock to actually at least pause? Support? So for a short trader, the profit is going to be close minus the nearest support, okay? So this is what actually we have incorporated in the software, and because now the support resistance levels are automatically calculated, what we do is we give you the profit for the long and the short based on the auto support resistance levels. And here you can configure the stop loss, whatever stop loss you configure. For example, if I'm an intraday trader and I'm using 1 minute to 15 minute, I'm using 3 minute and 15 minute time frame, the default stop loss will be 0.5%. And then I can use this configuration to calculate my risk-reward ratio. So for example, here you can see an example of a risk-reward ratio calculation. So basically, where's my, where's my red dot? Even I can't see it. Okay, there you go. I have to like shake it and then it comes. Okay. So you can see that, let's say I was buying at the current close. Okay, this is the current close. Okay, the green candle. I have drawn a vertical line, which is the value is 1.27%, something like that. Okay. Now that is my potential profit. Why? Because my nearest resistance is this light blue line. It's not that strong line, but it's still still a line where I can expect the stock to pause, right? So what I would do is the risk reward, the reward should be the reward is 1.27%, and the risk is 0.5%. The stop loss, if I'm putting, is 0.5%. So that's why we are giving you here this value of I think 3.5 or something. Am I reading it right? 1.27, right? 2.54 or something. It's not very readable, but it's 2.54, basically double of what this is, right? So that's a good risk reward ratio. And generally what then we do in the software is also give you the scans related to the risk reward ratio. So you can now scan for the high risk reward ratio also. So that gives you, okay, what stocks are going to have a higher risk reward ratio if you were to trade them. Any questions on the risk reward ratio? It is automatically because yes, yes. So this length is basically, I've just used a drawing tool to just draw this. It's a percentage tool. Yeah, just to show here how it's calculated. There's no other thing. Otherwise, you visit the chart and it will show you the risk reward ratio. And there will be two risk reward ratios, the long and the short. Which one? Yeah, this small overlay here, this one, which is showing all this open, high, low, close, and the risk reward ratio. See this? This value is shown over here. It's automatically calculated. I just tried to show you as a which levels? No, levels it doesn't show because see, typically it is the nearest one. No, we don't want to cloud all the too much of values over there. That's the reason. Okay. Any other questions? Yeah. Mm-hmm. Mm-hmm.
Is there any study which tells you,
Mm-hmm.
I mean, is this 10% based on your experience or is this 10% based on some empirical studies showing
No.
long-term stocks like
No. I don't think there's any study or anything as far as I know. I think what you should do is really you should set your expectation of gain. Okay, what your expectation of gain is. And then based on that you can put a stop loss. Because if you're really expecting the gain to be say 60% or something, you can maximum increase this. No, I mean as far as I know there is none, but again, I mean
for a number of stocks, like say 50% of the stocks that in the long term, that it falls below 10%, then it goes on further more.
No, I don't think there is any. No. Yeah. You can put 10%, 15%. That's why it's adjustable. That's a good point. So for all-time high, we don't have any levels on the top because it is an all-time high, right? So in that case, we don't calculate it. We just mention it as high. We cannot have a given number to that. Yeah. Everything, yeah, it's all automatic. So as soon as if I go from 15 minutes to 3 minutes, then all the levels will be auto-calculated, and the risk-reward ratio will also be auto-calculated. Everything is, it's in real time. I mean, ours is basically a 1 minute real time. It's not tick by tick, it's 1 minute real time. But that is pretty much 1 minute snapshot. So every minute you get a real time, 1 minute candle. Sorry? Yeah, so the stop loss is also drawn on the chart somewhere. That is basically based on again, whatever settings you have done on the tools options. Mm-hmm. Yeah. So see, basically, if it's a weekly time frame, then on that configuration window here that I showed, see here you can mention that okay, long term, daily to quarterly. It's saying no here. There's an option. So the weekly would fall in that, and then the stop loss will be based on that, and it will show on the graph. So it is again whatever you have decided that is shown here. Yeah. Okay. But again, as you all know that if you're long something and the other stop loss is also your support. So there are two things, right? Then you can choose whichever one you want to go for. All great questions. Good. Yeah.
And decide whether you're going to sell or hold for some time.
You are saying that you've broken the 52-week high, or you are near that?
You are maintaining that. Let's say,
Yeah.
of course, first thing is you want to
Frankly speaking, if you have made good money
Yeah.
and you're happy with
Come
it,
out.
and if you have something else that you can put your money,
yeah, so
then
logic should come out.
yeah, it's a very subjective thing, frankly, right?
You also end up investing in poorer scripts.
No,
That's the human cycle.
that's
Yeah.
very difficult to decide. That's
Trust me, selling is the more difficult. Which one is more difficult, selling or buying?
selling is more difficult.
Why?
Selling because greed comes.
Greed, and you get married to your stock, right? Instead of getting, instead of loving our spouses, sometimes we end up loving the stock, right? You get emotionally attached. So selling is always more difficult. Okay, so all very good questions out here. So in the interest of time, let me just go on, and I'll have the questions at the end. So how do we improve our accuracy? Because at times what happens is that all these support resistance levels are there, but you can also have false breakouts. In fact, even in the chart that I showed, there were some of them which were false breakouts and false breakdowns. How can you minimize those false breakouts is the question. Because if you minimize those, then you can also minimize your false signals. So there's a concept of supply-demand zones, support resistance zones, where you can actually club the nearby support and resistance levels and call it a zone, okay? And you treat it as a resistance or support. Entire area, you treat it as a resistance or support. That's the idea. So what happens is that by using the SR zones, you're improving your accuracy. And if you look at a Nifty with a auto SR on this chart here, these dark blue lines in this case are all the very strong resistance and support lines. This is a more or less sideways chart. This is a very recent intraday 5-minute chart of Nifty. Now you can see here that somewhere like basically if you see this level here, the 8556 and 8592 and all that, you can see that these two lines are very nearby. Okay, and it doesn't make sense. For example, if the lower line is broken, it doesn't make sense to really make any decision. You'd be better off if the entire zone is broken. That's the idea of a zone, right? You're basically maximizing your chances of success. So what happens is, if you see this case, in this case, that same zone, when broken, is going to turn into a support zone. Once it's a resistance zone, if your close is below the resistance zone, as soon as it's broken, again it's going to turn into a support zone. The concept is very similar, except that you are treating an entire area. So this thing, wouldn't it be nice if the zones were also plotted on the chart? And we have a demo in our stall, if you want to see, where now these zones are also automatically plotted, right? So of course there are so many zones, if you imagine. So what we try to do is we just show you the most highly rated zones, the strongest zones, because again those zones will be the ones which have the most number of touches or have been tested a lot. That's the idea, right? So that is something that we have. It's not released yet, but there's a demo in our stall if you want to check it out. And how does one use the support resistance zone? That is very important. To use support resistance zones, basically, how do you use it for buying on breakouts and selling on breakdowns? So what you do is, if you have a resistance zone, what do you think you should wait for? Should you buy on the breakout of the lower resistance line or the upper resistance line? Upper, right? You want to wait for the entire zone to be broken before you are safe to buy. That's the idea. So the first thing is buy only if stock goes above the upper resistance in a resistance zone, right? What about shorting? Opposite, right? For shorting, you want to short the stock only if it goes below the lower support in a support zone. Now when you're setting targets, it's a little different. When you're setting targets, when you're using the support resistance levels to set targets, you have to treat them differently. Why? Because again, that same greed thing. If you reach the lower, what happened? Okay. So if you reach the like if you're buying and if you have a resistance zone above, then should you wait for the upper resistance line? Why? Yeah, why you want to be greedy for that small amount, right? It's the same thing. So might as well just liquidate when the resistance is reached, okay? And similarly for short selling, you want to use the upper support line as a target. So it's a interpretation is different based on what you're using it for. As I think everybody now agrees that support resistance lines can also be used as targets because resistance and support. So same way you can use the support resistance zones also. Of course, in this case, it actually went up. That's a different thing. But it could have it could have come back down here because there's a zone out here. Might as well liquidate on the lower resistance line, right? Similarly, if I were to short at the very top, then I would probably my target would probably be the upper resistance line here on this upper zone. Okay, so that's the whole concept. Now, of course, I mean, everybody, who comes to an exhibition like this or conference like this, at least you want to know one strategy or one. I am happy to say that there is one thing that you can do which takes the combination of different scans. Like there's a very strong resistance breakout scan and a volume gainer. I mean, how many people use a scanner or a screener out here? Everybody know what a scanner does, a screener does? Okay, so imagine there are about 1500 plus stocks in NSE. Suppose you are an NSE trader. It is not possible to navigate through all the charts, right? Everybody agrees, nobody has the time to do that. So a screener actually allows you to filter stocks based on criteria that you have, and then you can trade on only those stocks. That's what a screener does, right? And out here, basically, any software, generally any technical analysis software, will have a scanner which will allow you to scan for different stocks, meeting, say, some indicator criteria or some volume gains or all those things. Because of the AutoSR, what we have is we have the breakout scans also and breakdown scans also. You can combine with the volume gainer scans. Means a stock is also having a very strong resistance breakout also, and also gaining on volume, and also has a high risk reward ratio. Combination of this actually can work out quite well. But of course, you still, again, you still need to look at the chart and see if it is all looking good, because sometimes it will be like a thinly traded stock and all that, but otherwise this combination can work quite well. So in case you want to sign up for a trial or demo, this is actually ships right in the software. As soon as you start the software, it's a potential, we've given some a name for the scan. And it gives it. Similarly, for a breakdown, you can have a similar combination. So like this is a screenshot of a stock that is coming in one of these scans. As you can see here, there is a high volume breakout here. Plus, you can see the nearest resistance is quite far. And plus, the volume is also there. So all the criteria are getting satisfied here. All right, so I think I'll probably conclude. How much time do I have? 5 minutes, no? Okay, thanks. I'm done, so that's good. So basically, this feature is available in our software right now, and it was launched a year back. AutoSR zone detection is also going to be available soon, but it's available. We are showing a demo of it in our stall. If you are interested, you can visit our stall number 11 on the ground floor. And also you can register at the stall, as I said, to get the slides. If for those people who are interested in the slides, we are also having, this finance and capital markets can be a little boring. So there's a game where you can spin the wheel and get some offers over there. And one of the offers is also a workshop that we are conducting, technical analysis workshop that we are conducting in Pune. We are organizing in Pune, and it's being it's being conducted by, the trainer is going to be Mr. Hemant Kale, who's a renowned author, mentor, trader, and coach. And if you want to talk to him, he's also sitting in the last seat, or he'll also be available as a stall later on. It's on 4th March. Okay. All right. So thanks a lot, everybody. If you have any questions, I'm here for another 5 minutes. Anybody has any questions? So see, basically, I think all traders have their own strategies. I'll tell you what I have followed over my trading career is basically mostly support resistance breakouts on volume. Simple thing. I also believe in simplicity, like Abhijit earlier, and I don't want to make generally things too complicated. So and also because I'm a more aggressive trader, so I'm not happy with the sideways kind of a strategy. So I like to have trade on volume breakouts and all that. Okay. Thank you all. Thank you for inviting me for this talk, Finbish. Thank you.